welcome to another episode of Classroom. This is our final chapter on elections, politics, the economy and how all that mixes up with the market. We've been talking in the past about the impact on equity markets. This time, it's time for perspective from across markets. Are elections or do elections impact money markets as well? What's the impact on the economy and are there any correlations to draw between who comes in as a combination at the top and how that affects economic growth for our country? I've got a full house today on Classroom. Sanjeev Prasad of Kotak, Hasib Drabu, who's been watching the economy and the internals of it for a long time now, and we'll get a money market voice going as well. Rajiv Anand will join in to talk about how bond markets and currency markets might react to any big moves there might be in the election run-up. Gentlemen, great to have all of you on the show. Hasib, let's lay the foundation for this first. For the economy in general, do you see this time round any expectations because of what might happen in the elections or any repercussions because of it?
Yes, certainly. I mean, like we've seen in the past as well. I mean, I'd like to split it into kind of two parts. The effect of elections on the economy can be distinctly divided into two parts, pre-90 and post-90. Pre-90, the impact has been very simple, that driven by fiscal policy, public investment, and you would tend to see election year and immediately the one after elections would always see high growth, largely because of fiscal stimulus that was provided during elections and all. But post-90, I think it's become much more complex, and as you said, there's a whole impact on markets. But this time around, I think there is going to be a far greater impact than has been in the past, because if you see what's happened the pre-election year, a lot of fiscal policy measures have been taken, perhaps because of the economic situation we are in, and all that is going to get accounted for in the post-election year, which is, let's say, after June, July. So you will see a major impact in the post-election policy making. Fiscal policy will have to get its act together, and obviously it's going to be a very expansionary fiscal policy, because most of the stuff in terms of expansionary has been already done, and correspondingly will have an impact on how the monetary policy will adjust to it. So you will see a fairly significant impact July onwards, which will impact not just the equity markets, which is, you know, very obvious, but it will also affect the debt markets, it will also affect the currency markets, and it will obviously affect the economic growth in the year to come.
Rajiv, hi, come in on that, because we haven't really focused on what exactly the expectations of the money market might be or what their concerns might be going into the elections. How would you define them?
I think initially I think the criticality here really is first and foremost whether we get a stable government, and more importantly, you know, whether either the BJP or the Congress is part of that government. I think if either of the two large parties with at least a reasonable sort of seat holding, you know, come into government, I think everybody will heave a sigh of relief. As far as the money markets are concerned, I think that's already playing out. The giant size fiscal deficit that we are now running, and really how that's going to get funded is really the number one issue. And as Hasib was saying, how monetary policy would really adjust to that. But I think the monetary policy is playing lesser and lesser of an impact. And what we're really seeing is a steepening of the curve, with the short end being driven lower and lower by monetary policy, and the long end being driven up because of the large size government borrowing program, and the fact that with long end rates going up and the concomitant impact on mark to markets of banks, etc., that's really playing out in a completely different manner. And I do believe that will continue for some more time.